This is Chapter 7, Question 11a. So in this problem, we have a number of transactions for signed supplies during the month of May 2019. We've got 7 transactions, and we're asked to journalize them using the perpetual inventory system, rounding them all to the nearest dollars. On the next slide, I'll go through each of those transactions. So the first transaction for this company is on May 14th, we sold merchandise on credit to Elements for $10,000, terms 210, net 30, freight on board, destination, cost of goods was $8,500. So on May 14th, the first thing we need to do is debit accounts receivable to set up the amount owing from the customer, crediting sales revenue for $10,000, which is recording the sales on account. The next step we need to do is record the cost of goods sold. Cost of goods sold, we were told, is $8,500, which is a debit to the cost of goods sold to increase the expense, and a credit to merchandise inventory to decrease the value of inventory on hand for $8,500. We're also told on May 14th that Signed Supplies paid $50 to ship the goods to Elements. So in that situation, we need to record the shipping expense as a debit of $50, and we paid that in cash, $50, to record the paid shipping costs. The next item is May 16th. Elements returned $500 worth of sales price of merchandise inventory from the May 14th purchase, and costs of those goods were $375, and they were returned to inventory. So in this situation, we need to record the sales return. So it's a debit to sales return, which is a contra account to sales revenue. And we need to credit our receivables. They owe us less money. They originally purchased $10,000. They're returning $500 worth of items. We're also told that the items are coming back to inventory. In order to add those back to inventory, we need to debit our inventory for the value being $375 with a reduction to our cost of goods sold, so a credit of the same $375 as those items came back to our inventory. The next item is on May 17th, received payments from Elements for the May 14th sale. In order to determine the values, we actually need to do a little calculation. In this situation, the organization had an original purchase of $10,000. They returned $500 worth of items. So the net purchase was $9,500, which is the amount sitting in the accounts receivable. So we know that we need to credit accounts receivable for the $9,500. However, they are paying within 10 days. The terms on their original purchase was a 2% discount if paid within 10 days. A 2% discount times the amount owing of $9,500 would be a discount of $190. So therefore the net amount owing, or the cash amount owing, is $9,310, which is the difference between $9,500 of the AR and the $190 discount. We would then debit sales discount for the $190. Again, this is another contra account to sales revenue. And then we would debit cash account for the $9,310, which is the actual amount of cash received from that customer. The next transaction, it says on May 18th, we sold merchandise to credit to Litmus for $6,000. Cost of goods sold was $3,600. So we have a $6,000 sales revenue credit with a $6,000 accounts receivable, debit to that account, with the cost of goods sold being debited by $3,600, merchandise inventory being credited by $3,600, which is a credit to inventory to reduce the amount of inventory remaining on hand. May 26th, we're told that Litmus kept the merchandise purchased on May 18th. However, some of it was defective, so we agreed to a 50% allowance on sale. So in this situation, we need to debit the sales returns and allowances and credit the accounts receivable for $3,000, which is half of the value of the original purchase. And in this situation, there is no cost of goods sold adjustment like the original return for the other customer. Because the customer kept the inventory, we are just letting them pay less for it because it was defective. The last item is May 31st. They made a payment from Litmus for the May 18th sale. May 18th to May 31st is 13 days. The discount was at 2% if paid within 10 days. So there should be no discount provided for this customer. The amount owing then is the full $3,000, the original $6,000 purchase, plus the $3,000 return. So the net cash coming in the door should be $3,000 as a debit to cash and a credit to accounts receivable for the same amount for receiving that payment on account. I hope you found this discussion helpful.